Where should I invest my money? As a financial advisor, this is the question that I get all day long from my clients, my friends, people that stop me on the tube. They all want to know what they should be doing with their money next. For some people, it's a question of whether they should be paying into a pension or an ISA or overpaying their mortgage, whilst others understand these basic tools, but they want to know what comes after that. So in today's video, I'm going to tell you what I think is the optimal order to tax efficiently invest your money from the first £1,000 to the first millions. This is a pretty ambitious video because we're going to be covering pretty much every single way that you can invest, some of which you'll be familiar with, some you won't be. Everyone has a unique set of circumstances and goals, so please bear in mind that I'm not going to be able to cover every situation in this video. There may be some personal reasons why you might want to change up this order, but for most of you, this is the step-by-step process that you should be following. So let's get started. Before you start investing, the first step is to make sure that you've built up an emergency fund of cash, typically between 3 and 9 months worth of your core expenditure. This is there to help you manage unexpected costs or if you lose your job, but it's also there to help you become a better investor. Investments can go down as well as up, but if you have an emergency fund, you will feel confident that you're not going to need the money that you're investing for a very long time, so that when your investments fall in value, which is going to happen at some point, it makes it much easier to stomach. The amount of cash that makes you feel comfortable will be personal to you, but challenge yourself on this. If you're a risk-averse person in a stable job in a double-income household with a high savings rate, ask yourself, do you really need a lot of cash? Or if you're thinking, why would I bother holding any cash at all when you're comfortable managing expenses on a credit card? Zoom out a bit, because if you're thinking like this, you're probably also taking risks in other areas of your life. Maybe you work in sales, you've got a big mortgage, cars on finance, high risk investments. So when it comes to an emergency fund, maybe you should be a bit more conservative. Deciding where to hold cash is easier for basic rate taxpayers, not only because it's likely that you'll have ISA allowances available, but you'll also get a personal savings allowance, meaning that the first £1,000 of savings interest that you receive is tax-free. This allowance is reduced for higher earners and then removed entirely. And given that interest rates are now high, you might start to pay tax on that interest. You could use a cash ISA, but many high earners will be using these allowances to invest. So if you're married, first, look to balance cash between you to make use of both of your allowances. But if you're both maxed out, look at premium bonds. The average payout is lower than a competitive savings account, but because the prizes are tax-free, it can be a good option for higher rate taxpayers. Now, I could do an entire video on each of these options. In fact, I already have for many of them. But today, I'm going to explain each of these at a high level and why I think they should be used in this sequence. Generally, I think that you should be looking to complete each tier before moving on to the next. But as you'll see, within these tiers, the order is more flexible. Once you have an emergency fund, you should be looking to tackle this second tier simultaneously. Insurance is arguably the next most important thing, and it's the most commonly overlooked. Everyone understands home insurance. There's a low probability that your house might burn down, but if it does, you're screwed. But for most people, your most valuable asset is not your home. It's you and your future earning potential, your human capital. And what if that burns down? What if you get ill and are unable to work? How will you survive? How will you pay the mortgage, feed the family? Or what if you die? How will your family cope without you financially? In the UK, we are twice as likely to have insurance for our pets than we are for ourselves. And we tend to over-insure high probability risks with small financial impacts like phone insurance and extending warranties, whilst under-insuring tail risks that actually happen much more often than you think and are truly devastating when they do. Your employer may offer some life cover and income protection, but it's often not enough. The larger your human capital and the more people that are dependent on it, the more insurance you should have. So think carefully about the support that your family would need in the event of your death or if you were unable to work. In the description, I have left a link to an Aviva calculator that can help you assess what type and level of cover you might need. It told me that I could get £1 million of life cover for just £45 a month, so this stuff can be affordable. Next, pension contribution matching. If you're employed, your employer should offer you some sort of pension contribution match. If it's a defined contribution scheme, at a minimum, if you contribute 5% of your salary into your pension, your employer will pay in an additional additional 3%. But they can be even more generous than this. When I worked at HSBC, they would match up to 7% of the additional pension contributions that I chose to make. So not only was I getting tax relief on my contributions, but HSBC was doubling my money. No other investment opportunities come even close to this, so make the most of this as soon as you can afford to do so. Paying off high interest debt. What I define as high interest varies depending on who I'm talking to, but broadly, it's anything above 6.5 or 7%. Paying down debt is a guaranteed tax-free return on your money. If the interest rate is 7% or above, there are no investments that can beat that reliably, other than pension contribution matching. People often understand this when it comes to credit cards or personal loans, but what they often miss is car finance. Most of these deals have high APRs sitting behind them, so paying it off is likely to give you a better return than any investment that you could make. Once you've completed this first tier and you have additional cash that you want to find a home for, you can move on to the next, where we have 3 options: contributing to a stocks and shares ISA, a pension, or overpaying your mortgage. A LISA can also be useful if you're saving to buy your first home or you're a basic rate taxpayer, but today I want to focus on these mainstream options. An ISA and a pension are the main tax efficient tools that we have for building wealth in the UK. Like most of the tools we're going to look at today, these are not investments in and of themselves. They are a wrapper that the investments sit within. Choosing what wrapper to use and when is the hard part, and that's what we're going to be focusing on today. Once the money is inside the wrapper, you can choose how that money is invested, and it's actually much easier to make that decision than it sounds. For most people, all you need is a globally diversified portfolio of low-cost index funds. In fact, you may only need one fund. And in the description, you will find a link to a series of videos where you can learn more about this. Inside both an ISA and a pension, your investments will grow free of tax. But because you get income tax relief when you contribute into a pension, and you're likely to pay less tax when you take it out, they are generally more tax efficient than ISAs. But you can't access the money in your pension until 55 at the earliest. Therefore, if you're a long way off retirement and you're already getting your employer pension contribution match, prioritizing investing into an ISA can make sense in case you need to access that money before the age of 55. The game with pension contributions is to get as much tax relief as you can when putting money in. The more tax relief you get, the less you need to save to achieve your retirement goals. And at certain income thresholds and points in your life, making pension contributions can be extremely tax efficient and can help you to reclaim child benefits. You don't want to miss out on these opportunities, so plan ahead and recognize that when the time comes, not only may you want to divert your monthly savings from your ISA to your workplace pension or a SIPP, but you can even cash in your ISAs to make even larger pension contributions if necessary. You should also look to do this in the run-up to retirement when you no longer need the flexibility of an ISA and you're looking to make the most of the tax advantages of pensions. But you need to be mindful of pension annual allowances. The maximum that you can contribute into a pension this tax year is £60,000, although for every £2 that you earn over £260,000 per year, you lose £1 of your pension allowance, up to £360k, where the max that you can put in a year is £10,000. This is a nice problem to have, but if you do anticipate getting to this point at some point in the future, make the most of your pension whilst you can. The same applies if you think that you might stop working in the future to have children. The final option on this tier is to use your cash to overpay your mortgage. This is a highly personal decision that everyone's going to feel differently about, and I've done a lot of videos that look at the pros and cons of investing versus paying off your mortgage. But think about it like this. Because house price to earnings ratios are at all-time highs, our generation has more wealth concentrated in our homes than any generation that has come before. So if you already have a repayment mortgage, I think it makes sense to diversify and invest in other things that give you more flexibility before you think about overpaying. But ultimately, you just need to make a decision that you feel comfortable with. These first 2 tiers contain the tools that most people will use at some point in their lives. But if you're lucky enough to be maxing out your ISA and pension allowances, or perhaps you don't want to contribute more to your pension right now because it's already too big, or you don't want to tie that money up until retirement, the next step is to look at using a general investment account. This is a standard investment account that has no tax advantages. This tax year, we have smaller dividend and capital gains tax allowances than before. So any dividends that you receive or capital gains that you realize above these allowances are going to be taxable. But if you're married, you could open a GIA in your spouse's name to make use of their allowances and lower tax rates if they're in a lower tax bracket than you. Ultimately, if you end up paying tax on investment gains, that's a good problem to have. But at a point, these tax headwinds will get pretty high. So if you do find yourself with, say, more than £200,000 in a GIA, it may be time to move on to the final tiers. But before we look at those, there are 2 other options you could consider on this tier. At this point, you may want to start contributing to junior ISAs and junior SIPPs for your children. I think it's best to prioritize maxing out your own pension and ISA allowances before you invest for your kids. And I've done a detailed video on why that is, so please do check it out if you're interested. Investing in residential or commercial property could be another option. Although it is possible to make good returns with these, do not assume that it's easy or that it's passive. Property investing sounds great on paper, but many people underestimate the risks and are surprised when investments turn out to be poor, especially after taking into account recent tax changes and the hassle that's required. That's not to say that property can't play an important part of a diversified investment portfolio, but I find that most people, especially high earners, prefer to use truly passive investments that offer more tax efficiency and flexibility and leave them free to focus on other areas of their lives. Now, you may have heard of this concept of having a core and satellite investment portfolio, where you have the core invested in a traditional, highly liquid, diversified portfolio of stocks and bonds, but then have a small satellite allocation for more exotic, high-risk investments. This could include collectibles, angel investing, or even crypto. Ultimately, this is money that you're comfortable that you might lose in the pursuit of higher returns. This is certainly not a strategy for everyone, but these next three options could form a part of that allocation. Venture capital trusts, EIS and SEIS, are schemes through which you can invest in small, innovative startup businesses, whilst at the same time getting generous tax breaks from the government. Although these companies may have exciting growth prospects, they are extremely risky. Typically, over 50% of new companies fail within their first 5 years. So there is a high chance that you will see a permanent loss of capital. And even if companies do survive, because they're private, it can be very hard to sell the shares. This is why these types of investments are typically only recommended to experienced investors that have a very high tolerance for risk and a long-term investment horizon. Because of the high failure rate of these companies, diversification is very important. Venture capital trusts have an advantage here because they're set up as funds managed by a team of professionals. So when you invest in them, you're immediately getting exposure to the fund's existing portfolio, typically between 20 and 100 different companies. Because the government wants to promote investing into small, innovative UK businesses, these schemes come with generous tax incentives. If you invested £100,000 into a VCT, you would get 30% tax relief, meaning that you could reduce your income tax bill by £30,000 in the year that you make the investment. However, you need to hold these investments for a minimum of 5 years or that tax relief will be clawed back. In addition, capital gains and dividends that VCTs distribute are free of tax, which is why VCTs tend to target paying a high dividend yield. EIS and SEIS involves investing into individual companies that have qualified for raising money through these schemes. EIS is focused on more established businesses, while Seed EIS is for early stage, high-risk startups, which is also why they offer higher tax incentives. Because you need to research these companies yourself, make a lot of investments to get diversification, and the fact that you may have to wait years, if not decades, until you have an opportunity to sell your shares, I think these types of investments are only suitable for people that want to get actively involved in angel investing and are comfortable that most of these investments will fail. On the other hand, VCTs that give instant diversification to more established businesses can be suitable for a much wider array of people. I've only briefly touched on the pros and cons of these schemes, but given that this is a very high risk area of investing, you should definitely seek financial advice before getting stuck into this. Because of the risks, many people will want to bypass this tier entirely and move straight onto the final tier, where we have offshore bonds, family investment companies, and discretionary trusts. These are complex and very hard to unwind if you get them wrong, so you will definitely need professional advice before getting into these, but I want to help you understand when they can be useful so you know when to get in touch. Again, all of these are just wrappers. You can invest in pretty much whatever you want once the money is inside them, but because of the setup costs, you typically only use one of these if you were looking to invest at least £100,000. Although an offshore bond sounds like some elaborate tax evasion scheme, these are actually very standard financial planning tools. Although technically an insurance policy, an offshore bond is essentially an offshore investment account, typically situated in either Ireland, the Isle of Man, or Luxembourg. Their key advantage is that money invested within the bond grows free of capital gains or income tax, but you may have to pay income tax on the growth of the bond when you cash it in. You can draw down 5% of what you originally invested into the bond each year without triggering any tax charges. This is a cumulative allowance, so if you don't use it one year, you could draw 10% the next, and so on. If you do decide to cash in more than this, any growth in the bond's value will count as taxable savings income. In the UK, you pay much higher rates of tax on savings income than you do on dividends or capital gains. But because you have control of when you draw this down, you can do it in years when you have a little to no income, or perhaps when you've moved abroad to a lower tax jurisdiction. You can also gift parts of your bond to family members, with tax only being paid when they cash it in and paid at their own marginal rate of tax. There are other tax considerations that are beyond the scope of this video, but in summary, offshore bonds can be very tax efficient ways to build wealth and pass it on to future generations. Family investment companies and trusts are less about tax efficiency and more about passing assets to future generations whilst retaining control. They're especially useful if you don't trust your kids enough to just give them the money, or more commonly, you don't trust their relationships. A FIC is similar to a limited company that you might set up to invest in property. However, they tend to have different share classes, where some have voting rights but no right to the capital, whilst others have no voting rights but have rights to capital and dividends. So as an example, if a grandparent set one of these up, they could hold on to the voting share classes but gift the other shares with the rights to the dividends and capital to their children or grandchildren, enabling the grandparents to start moving money outside of their estate for inheritance tax purposes, whilst continuing to control how the money is invested and how and when it's distributed to other family members. Discretionary trusts have a very similar objective, where trustees manage assets on behalf of beneficiaries, but they offer more flexibility in terms of the ability to add beneficiaries, and they enable those that set them up to instruct how funds should be managed beyond their deaths. If you're interested in legacy planning like this, you should definitely speak with a financial planner. They will be able to help you first zoom out and define your goals, help you to understand how much you can afford to give away, and then assess all the options for doing that. There are often simpler ways to achieve these goals, but if required, they will bring accountants or solicitors into the conversation to help set up these structures. We're all going to die at some point, and we have no idea when that's going to happen. So the earlier that you can get your financial affairs in order, the better. In this video here, I tell the story of a father who didn't, and as a result, left his family in a financial nightmare with a £400,000 tax bill to pay. There's also a link to this video down in the description, so please check it out.